Hello CA aspirants, welcome and welcome back to our channel CA Aspirants Comfort Zone. Today we are with the new subject, that is financial management. Let's revise the theory very fast. The evolution of financial management: traditional phase, transitional phase, the modern phase. What is finance function? This is important for all business. Starts with setting up of enterprise, raising funds, financing, utilization of profit, investment, refund, managing funds, risk taking. Basic finance function includes investment decision, financing decision, dividend decision. Two main aspects of financial function are procurement and utilization. Long-term finance function decision, that is investment, finance and dividend. Short-term finance function decision is working capital management. What is the scope of financial management? That is financial planning, capital budgeting, financing decision, working capital management, risk management, finance analysis and reporting, dividend policy, treasury management. Main objective of financial management is profit maximization, protection against risk, wealth maximization, stockholders' wealth we have to increase. That is the main objective of business also and of finance management also. Advantages of wealth maximization is emphasizes the long-term gains, recognizes risk or uncertainty, recognizes timing of returns, consider shareholders' returns, emerging issue affecting the future role of CEO or regulations, globalization, technology, risk, transformation, stakeholders management, strategy, reporting, talent and capability. The CFO roles are forecasting the financial requirement, planning, procurement of funds, investment or allocation of fund, maintaining proper liquidity, cash management, dividend decision, evaluation of finance performance, financial negotiations to ensure proper use of surplus, and also in shortly we can say finance analysis and planning, investment decisions, finance and capital structure, management of financial records, risk management. Coming to the next question, that is tasks involved in demonstration of importance of good financial management. No over investment in fixed assets, balancing cash outflow with cash inflow, ensuring sufficient short-term working capital, settling sales target for growth, increasing gross profit by settling correct price, by setting correct price, controlling the level of all expenses by cost efficient ways, tax planning for minimum tax. Steps to be followed by manager to measure and maximize shareholders' wealth are: cash flow approach, not accounting profit, cost benefit analysis, application of time value of money, profit maximization. There is the ultimate objective, right? We already saw here profit maximization and also the wealth maximization for shareholders. This is short-term objective. Main objective of business acts as measure of efficiency and protection against risk. The favor or ultimate objective to meet future contingencies. Finance for growth of business, measure efficiency and eco prosperity against that means the limitations or exploitation of workers and customers. Ignores risk, favor associated with profit. Profit is vague, different to different people. Narrow concept at cost of social and moral obligations. The next is wealth maximization. There is the second objective, that is long-term objective. Appropriate objective: the individual stockholder can use his wealth to maximize his utility. Single substitute for a stakeholder's utility. The favor things are short-term money lenders get their payment on time. Long-term lenders get fixed ratio of interest on investment. Shares of employees in wealth gets higher. Various resources are put to economical and efficient use. The against points are socially undesirable, not descriptive idea. Only stockholders' wealth maximization does not lead to firm's wealth maximization. Objective is endangered when ownership and management are separated. Main considerations of procuring funds are equity, debenture, funds from banks, international funds, angel financing. Coming to the next, that is types of financing, that is bridge finance, short-term loan taken by firms from commercial bank to despair loan sanctioned by financial institutions. This is short-term loan. The next one, what is the importance or need of bridge finance? This helps avoiding the cost overruns, useful to implement the projects on time. The characteristics are, it is a short-term loan, bridges the gap between the date of sanctioning the loan and finance distribution of loans. Rate of interest is high. These usually repaid as when term loans are disbursed. What are masala bonds? This is Indian name used for rupee domination bond that Indian corporate borrowers can sell to investors in overseas market, issued outside India but denominated in Indian rupees. We are selling it to the foreign people. Callable bonds has a call option which gives the issuer the right to redeem the bond before maturity at the predetermined price at premium, usually at premium. Puttable bonds, it gives the investor a put option right to sell the bond back to company before its maturity. What is clean packing credit? The clear type of export advance for business of packing goods for export. The types are clean packing credit against a pledge of goods, packing credit against hypothecation of goods, ECGC guarantee, forward exchange contract. What is venture capital financing? Financing of new high risky venture promoted by qualified entrepreneurs who lack expertise and funds to shape their ideas. Form of equity finance, or the methods are equity financing, income note, conditional loan, participating debenture. There is a setup phase, it will be no interest. For second phase it will be low interest. For third phase the high interest will be high. In equity financing, because it's long term financing. Income note, hybrid interest plus royalty in low rate. Conditional loan, paid in royalty, no interest will be there. Debt securitization, process of transforming the asset of lending institution into negotiable instrument for generation of funds. This is sold as liability, loans and trade receivables, and as assets. The advantages are, asset is shifted off the balance sheet, converts liquid assets to liquid portfolio, better business management, satisfaction of capital adequacy norms, the organization's credit rating enhances. Process of debt securitization are organization function, that is bank giving loan to borrower, pooling function, charge on special purpose vehicle, securitization function, conversion of debts to securities, elements of leveraged lease, third party involves to provide money, lessor borrows a part of purchase cost from a lender, that is third party, asset held as security, lender is paid off by lease in lease rentals. The difference between operating and finance lease is, lease term is a major part of economic life of asset, but in operating lease term is less than a life of asset. We have seen this in accounts also, that is in one of the AS about leases. Transfer of all risks and rewards to lessee. Here it is not like that. The risk and rewards will be in the hands of lessor only. Risk of absolence falls on lessee. The risk of absolence falls on the lessor himself. Continuation of lease is reasonably certain in finance lease, but in operating lease it is not reasonably certain. Generally not cancelable unless the contract is finished in finance lease, but in operating lease it is generally cancelable even if the contract has been made. or before the contract ends. Advantages of leasing are flexibility, lease may cover 100% cost, time saving and quick documentation, operating lease, safeguard from risk, helps the borrowing capacity of lessee, does not affect the department position, sale and leaseback helps solve the financial crisis, helps for small equipments, tax benefits. The disadvantages of leasing are lease rentals are soon payable after acquisition, may not be suitable for new projects. Credit facilities from bank are high rate of interest and they create charge on asset. Default in payments of interest leads to seizure of asset by bank. Sources of short-term financing requirements of the company are trade credit, commercial paper, bank advances, treasury bills, working capital loans from commercial banks, fixed deposit for 1 year or less, advance received from customers. Coming to the next point, that is forms of post-shipment finance, purchase or discounting of documentary export bills, ECGC guarantee, advance against export bills sent for collection, advance against duty drawbacks, cash subsidies, etc. Four finance instruments we can write. I have given here eight. If you remember the four, that is enough. Euro bonds, floating rate, euro commercial paper, fully hedged bond, euro issue, foreign bonds, foreign currency option, foreign currency futures. That is, euro bonds is a long term loans, excellent credit rating. For them it will be given. Debit instrument other than currency of the country, bearer from non registered bond, floating rate notes, low rate of interest than loans up to 7 years. Euro commercial papers, promissory notes which is less than 1 year. Fully hedged bond, risk of currency fluctuations. Euro issue raises foreign currency in international market. Foreign bonds, debenture instrument dominated in currency sold in country of that country. Foreign currency option, buy or sell at spot, saves from economic risk. Foreign currency futures, sell or buy at future date. These bonds are issued by non-US banks and non-US corporations in US, that is Yankee bond. The features of it are denomination in dollars, issue by non-US banks and non-US corporations, issued in USA, registered in Securities Exchange Commission, issued in tranches. Time taken can be up to 14 weeks. Interest rate is in dollars. The next point that we are going to revise is deep discount bonds. Form of zero interest bonds sold at discounted value and on maturity face value. Bonds are sold in market. Difference between fair value and market price is capital gain. Capital appreciation is charged to tax at capital gains rate, which is lower than normal income tax rate. Considered a safe, solid and liquid instrument and assigned the best rating. Global depository receipt and American depository receipt. Will know the difference between these. Issued in European capital markets, but the American is American domestic capital market, listed in non-US stock exchange. This is listed in American stock exchange. Hope you are watching the screen so that I'm not repeating for what points I'm saying. When I'll be pointing, please note it. Negotiation in all over the world, but for this in America only. Created by, these are created when the local currency shares of Indian company are delivered to depositories local custodian bank against which the depository bank issues deposit receipts in US dollar, created by depositing the securities of Indian company with a custodian bank. The meaning of this is basically negotiable certificates denominated in US dollars that represent a non-US company's publicly traded local currency equity shares, that is the cost is less. Negotiable certificate denominated in US dollars that represent a non-US company's publicity traded local currency, equity shares, or securities, the cost is usually high. The features of commercial papers are short-term maturity, unsecured, discounted insurance, a high credit quality, liquidity, interest rates, no regulation. Secured premium notes or secured premium fixed rate, interest rate, maturity within 4 to 7 years, proprietary in claim, credit risk documentations, cover rents. Foreign currency convertible bonds or low rate interest foreign currency at low cost, redeemable at maturity. Plain vanilla bond, purchase and investment payment, no option, may issue discounted bond. Convertible floating rate notes can convert to long-term debt security, protect investment in falling interest, can be sold in market and earn profit. Capital gain is not available. Drop lock bond, floating rate with normal float note, automatically convert into fixed rate bond in interest falls. The new fixed rate stays till the drop lock bond reaches its maturity. This is long term option structure, but drop lock bond is short term option structure. This is the difference between these two. Finally, at the end of the theory part, variable rate demand obligation option exists, more liquid, can sell back to trustee. Types of leases are sales and leaseback, leveraged lease, sales aid leases, close ended and open ended leases. Hope you liked the video. In case if you want more videos on FM, please do comment down in the comment section so fast, so that I'll be able to upload it by today's evening. It will be helpful for your exams tomorrow. All the best, guys.